Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today, I'm going to talk about random things, go over some stuff, and there's some tweets that we're going back and forth that I'd like to kind of address. And I'm going to talk a little bit about portfolio strategy, portfolio allocation sizes, stuff like that. And my strategies, that's really what I'm talking about. It's not supposed to be used as advice or anything like that. It's just my opinion. And that's just all what it is. And I've talked to some people, and I think newer investors, what they do is they get an idea and they really pile in to one asset or just maybe a couple assets or one company that they like, and they become overexposed to that asset or company. We've had some positions, even myself, go to zero. Zero. So the way that I handle this is I don't put all my money into one stock. I don't put all my money into one sector. I spread it out. And the risk is very high if you go all into one sector, especially all into one company or all into one thing. So people who bought Bitcoin are probably feeling pretty bad right now if they entered in at a very high price level, like 55,000, 60,000, and whatnot. They're probably feeling pretty poor right now. Not too good with that big pullback. And I don't put 100% of my money in any one sector. I know there's a lot of people that are very bullish on certain sectors. And just, take into account that there is risk in a lot of these different things. So what you see myself doing is I allocate money to very good risk reward opportunities in the market, and I allocate some of my money, net worth, however you want to say it, towards that opportunity. And if something goes wrong, the way I'm hedging myself is with time. With time. So I know that these assets that we're going into are cheap. I know that historically they've worked under these market conditions and they've appreciated differently under the market conditions that are coming versus what we were going through 5-10 years ago. 5-10 years ago and going forward, we were in a disinflation, downward move in interest rates type of environment. We are coming into higher interest rates, higher or greater rates of inflation, and assets get priced differently. But it doesn't mean just because the statistics are in our favor and the winds at our back that you want to pile in all into one asset or all into another asset. They all inherently have risks. So what I do is I look at all the ideas out in the world, I look what's undervalued, and I pick my favorite undervalued opportunities. I diversify across the majority of those opportunities. I've had positions go to zero, like I said before. I had a couple. Well, I had Norilsk nickel, Nornickel, and that one potentially could go to zero. I don't know. It wasn't a large percentage of my portfolio. I think it was like 3% of that portfolio. So I lost 3%. Consider it a bad down day. But I live to walk another day. I've managed my risk through portfolio allocation sizing. My strategy is to buy undervalued assets, buy them when I think the market conditions are turning around, and then hold them for a long-term investment. Does that make my strategy right? No. Does it make it wrong? No. It makes it my strategy. Other people can't foresee holding for long periods of time. Those are mainly what I consider to be younger, less experienced investors. What you do with age, at least I'll speak from my experience with age, is I find the opportunities, I buy them when they're very cheap, and then I sit in it. I sit in it and I wait for that appreciation to happen, given different market conditions. So that's something that I look for. Another thing that I realized kind of over all these years of investing is it's not so much about the the sector that you're looking at. A lot of these things are tied together. So when I say commodities in general, the commodity sector is tied together. It's all kind of moves up and down together. Some of them take their run-ups, other ones are lagged behind it. But what a lot of people do is they focus so much on the sector itself, and all it is just a rotation of money. It's not even correlated to the sector, perhaps, or perhaps not. But the big commodity theme is driven by money flows, interest rates, and inflation. The way that money flows into each of these sectors may be dependent on the market balances, or maybe not. Maybe someone just wants to buy a bunch of oil because it's the greatest inflation hedge, or because maybe the market balances are bad there. Maybe it has something to do with technical analysis. There's a lot of different reasons why an individual or a group of individuals buy a sector. And that's why we look at charts, and that's why we look at ratios and know what's cheap. Cheap based off of history, at least, against other assets. So I think it's important to keep that in mind. When someone gets really bullish on a sector, it doesn't mean you pile everything in and all you've got. I just think there's too much risk. So what you're seeing, and what I've got the website and kind of, what I go over a lot of what I'm doing, is you're seeing me spread out across a bunch of different assets with different risk profiles. I view physical precious metals as the least risk. Call it insurance. I don't know, whatever you want to call it. I play the ratio swapping game. When a ratio gets cheap, I buy this asset and say this one's expensive. So this is cheap, I buy this one. And then when it appreciates, I sell this asset and buy this asset. It's that easy. And I do that against every single asset out in the world. Physical metals, I think, are just the least risk way to play it. There's no counterparty risk. There's no nationalization risk, tax risk, so on and so forth for a company. Maybe there's tax risks for an individual, but usually they've been pretty stable historically. So I diversify out. I've got that strategy. I use strategies to rotate using ratios. And that's really all you need to do as an investor. Now, I know a lot of people, they want to really push the leverage button. They want to make this a gambling bet. Be careful, because the timing, remember, I hedge myself with timing, which means I can sit in an asset for 10 years. In an option, you can't do that, and you're paying a premium to own that thing. So the way that option is being priced is it's being priced based off of the price, the volatility, and the premium of the length on it, the duration of that option. Longer duration, higher premium, and as you sit in it, that premium or that duration is shrinking on you. So you could have a stock go up and still lose money because your duration, the length left on the contract, shrinks. So I don't like playing those, because it basically forces me to get too many things right. It forces me to get the timing right. It forces me to get the price right. And it forces me to get the volatility right. And you can do that. I just think it's a lot harder to be successful over and over again. I also don't do anything on margin. So I don't borrow money to buy stock. I know when I was talking to some people earlier on the channel, they were all leveraged up. I was like, wow, that's a lot of leverage. Why are you doing that? You don't go, in my opinion, you don't go into commodities leveraged to the hilt and then have this volatility basically force you out of the stock. So I think that's a big problem with most newer investors. They go too much on leverage and too much margin, too many options, and all that stuff. I just don't think it's worth it. I think these are basically leveraged enough to do it with no leverage. Again, that's my opinion, not advice or anything like that. And I'm really slow to take in data. So I don't make, I don't see the first piece of data and then jump on that data. I'm very slow to react, just like the markets are slow to react in a lot of this stuff. I am playing structural moves, and structural moves don't happen quickly. So I'm very slow in my reading of data to make any sort of action to it, because I'm looking for structural changes, and structural changes don't change with a data point or 2 data points or 3 data points. And that might be a month worth, a 2 months worth, or 3 months worth of data. I might need to see a year's worth of data deteriorating before I really change my mind in some of these sectors. More importantly, the sector of housing. So when I see something kind of move down because interest rates have moved up so quickly, I'm not so quick to just sell everything. I'm not so quick to become from a bull to a bear. I need to see more data. I need to see what's going on. I know that the demographics support higher home prices for another couple of years at least. I would say at least another 2 or 3 years. Does that mean that a housing market is going to go up? Or does that mean that the housing market's going to crash? I don't think we're going to crash like we did in 2008. And I still think that the demographics are there. I still think that we have a housing shortage to some extent. And I'm slow to move on that data. There's no reason for me to move quick. When the data starts to deteriorate, like the mid-2000s, the mid-2000s is when the data started to deteriorate. It was 2005, 2006, 2007. It got worse and worse and worse. We basically peaked in 05 and it got worse 06, 07, and then 08 is when the crash is. So if the data is getting worse and it's going to maintain or continually get worse, well, we have time. So why would I react to that? The bull market in uranium lasted into 2007. Oil was 08. That was 2 years after the peak, 2 or 3 years after the peak of housing starts declining, of inventories getting pretty bad. We saw a steady increase of inventories. Now, we could see those same conditions, or we might not. And that's why I'm slow to move. These conditions are ripe for all of the commodities to take off. We see in the future, mid-2020s, that we have a large market imbalance in a lot of the commodities. We're running deficits is what I mean. Inventories are going to be drawn down. There's no reason to panic. There's no reason to be too quick to move. If the data last time took a couple of years, and if the data in the 1920s before that crash took a couple of years, the housing starts peaked in 26, 27. Some of them did peak later, depending on which city you were looking at. And remember, the data was much different back then. You wouldn't really have known at that time very quickly. But there was a huge housing, basically, bust in the 1920s into the 1930s. Commodities also did quite well in the 1930s. But you have to kind of be patient there. And you don't want to be jumping in and out of stocks at that time. So that's kind of my opinion there in terms of the data and why it may seem like I'm a housing bull. I'm not necessarily a bull or a bear. I'm just being slow with my thoughts and my movements in those markets. I'll be a bear when it tells me to be a bear. I'll be a bull when it tells me to be a bull. Right now, I don't know which one to necessarily be because we're getting conflicting data. We have low inventory and we have house prices continuing to go up on a year-over-year basis. They are slowly degrading from a month-to-month basis. But I don't know if that's seasonality. No one else doesn't know if that's seasonality either, because this is usually when the weakness in the market comes and hits. If we continue to add inventory, and if house prices continue to either flatten out or weaken, then I'll start to become more bearish. No reason to become more bearish at this time. And if it doesn't improve, if we continue to go lower, then we'll probably peak out in 2023, 2024, 2025, somewhere in that range, depending on how fast the housing starts fall, depending on how high interest rates get. It all depends on a lot of different things. If interest rates, let's say they lower interest rates, they start doing QE again. And I don't know if they'll do that. I don't think they will. But let's say they do. Well, that changes the whole market dynamic. That's why I'm slow to move on my feet. And I don't think any of these markets are going to move based off of news. It's all structurally driven. It's money having to leave those sectors, bonds, stocks, and into other investments. And that may spark, real estate even higher or other things. It depends on the rate of inflation, and it depends on what people get paid at work as well. It all depends. There's a lot of different variables that are being input into these models. And right now, since we're transitioning from probably the largest growth in real estate prices to slower growths, we're going to have to see how that all plays out. And if you guys want to obviously listen to this or continue to listen to content like this, definitely don't forget to subscribe. Don't forget the thumb up button. And if you guys like my analysis, definitely subscribe to the Platinum membership down below. But, I was just kind of thinking about this stuff, and I was talking to some people about this. I did talk to a mortgage broker, and he definitely said that things are slowing down. Yep. It's definitely slowing down from what it was in 2021. He said 2021 was absolutely ridiculous. It was absolutely ridiculous. But he also says that 40% of the people own their house. And that a lot of the people are in positive equity that he has dealt with. And that the loans are not underwater. The majority of loans are not underwater. So he doesn't think there's a crash coming, at least at this time. I hold the same opinion. So that's coming from someone who does, mortgages, a broker. So that's what I've got for today, guys. If you guys like the content, definitely, click the thumb up button. Don't forget to click the thumb up button. And we'll catch you next time. This is Finding Value.